In the intricate map of the human genome, one name stands out as the architect of its modern era, Illumina. But this isn't the story of just any corporation. No, this is the story of an empire built not on land, but on the code of life itself.
Is a chronicle of how they built a true infrastructure for science, a cautionary tale of a massive financial misstep, and ultimately a story of a deliberate, disciplined return to form.
So, our story begins with how this hegemony was forged, and to really get what Illumina is all about, you have to understand something crucial. They didn't just enter the gene sequencing market, they built the market's foundational infrastructure.
Think about this. The acquisition of Solexa, way back in 2007, was essentially the golden spike moment for genomics. It was an act of creation, like completing a transcontinental railroad, but for biological data. Before that, the world of genomic data was disconnected, hard to navigate. After, a whole new continent was opened up for exploration, and Illumina controlled the rails. This created a technological moat that was incredibly deep and defensible.
By 2019, the architecture of this economic empire was already crystal clear, just by looking at the numbers. The instruments, the big, impressive sequencing machines themselves, were just 15% of revenue. The real engine, the true source of its power and profit, was the recurring sale of consumables. These proprietary chemicals and flow cells made up a massive 68% of their revenue, a sure sign of a powerful locked-in ecosystem.
And a year later, that dynamic only got stronger. By 2020, consumables grew to 71%. You see, this was more than just a clever business model. It was, for all intents and purposes, a sovereign tax on the very progress of life science research. If you wanted to explore the fundamental code of life, you had to pay tribute to Illumina.
So let's just lay it out. This is the engine of the empire, plain and simple. The classic razor and blade model, just executed with absolute precision. The sequencers, those are the razors. It's a one-time purchase that gets you into their ecosystem. But the real durable value comes from the proprietary, high-margin consumables, the blades, that you have to buy for every single run. It creates this profound institutional inertia, locking customers into a predictable, captive revenue stream.
And the result of all this is a financial fortress. Projections for fiscal year 2025 suggest that approximately 90% of the company's revenue is recurring. That is the hallmark of a deeply entrenched, infrastructure-level business. It provides a powerfully defensible financial foundation for the entire enterprise.
But even the greatest empires can be tested. And often, the challenge doesn't come from an external foe, but from internal ambition. This is where the narrative takes a dark turn. This chapter is about a strategic overreach, a flight a little too close to the sun.
The acquisition of the cancer screening company Grail was the moment things went off course, and its cost is written in stark, unforgiving numbers. In the third quarter of 2022, Illumina had to record a goodwill impairment charge of $3.91 billion. Now let that sink in. This isn't just an accounting entry. It is a staggering public admission of profound value destruction.
And the financial hemorrhaging didn't stop there. Regulators who were already wary of the empire's expansion levied their own penalties. In 2023, the European Commission imposed a fine of 432 million euros, the maximum fine possible, because Illumina closed the acquisition before getting approval. This was the direct regulatory cost of strategic hubris. And beneath the massive write-downs and the huge fines, the asset they'd bought was itself bleeding cash. For the 2022 fiscal year, Grail posted a gross loss of $117 million. The acquisition wasn't just expensive, it was a drain on the entire operation.
This table just lays the whole strategic problem bare. On one side, you have the core Illumina business, an absolute bastion of profitability, generating over $3 billion in gross profit in 2022. And on the other, you have Grail, a consistent drain on capital and focus. It was a textbook case of what investors call diversification, taking a brilliant core business and diluting it with a costly, distracting venture.
So, faced with mounting losses and intense regulatory pressure, a change was obviously needed. This next chapter isn't one of growth, but of a calculated retreat, a great purge designed to restore focus and get back to the core principles of capital discipline.
The path to fixing things wasn't about adding something new. It was about deliberate contraction. Under new leadership, the company embraced a philosophy of creating value through subtraction. The decision was made to surgically remove the very asset that had come to define this era of strategic overreach.
And the timeline for this restoration was swift and decisive. In December of 2023, the divestment of Grail was announced. By June 2024, the spin-off was complete. And by the first quarter of 2025, a new $100 million cost reduction program was put in place, signaling a renewed, intense focus on efficiency and stabilizing the balance sheet.
And the financial results of the strategic purge? They were immediate and they were tangible. The gross margin of the core business, which had been squeezed down to 64.4% during the Grail distraction, recovered to 67.1% by 2024. This is the direct financial evidence of a restoration of discipline, a critical step toward rebuilding the business.
And so, that brings us to the present. The empire has shed its costly diversion and has refocused on its core dominion. The question now is not about the past, but about the future. What lies on the horizon for this foundational company?
And this is the essential question for anyone looking at Illumina today. Is this a fallen giant, permanently diminished by its strategic misstep, or is it a coiled spring, having shed an immense weight and now poised to release its stored potential, with its core business stronger and more focused than ever before?
To analyze this, we need to bring in a financial concept, valuation multiple compression. This is what happens when a dominant company, one with a wide, defensible moat, faces a period of intense market skepticism. Its stock valuation contracts, even as the underlying business remains powerful and profitable. This disconnect is often driven by the memory of recent strategic errors.
You know, history offers a useful framework here, the 2012 Apple analogy. Back in 2012, Apple was a dominant wide moat leader. Yet, after the death of its iconic founder, the market was gripped by skepticism. This led to profound valuation compression, with its stock getting cheaper despite record profitability. The market's perception had diverged from the reality of the business. Now, this is not a prediction for Illumina, it's a historical analogy, a lens through which we can analyze the situation where a market leader, after some turbulence, may present a disconnect between its temporary market price and its long-term intrinsic value.
After the strategic detour, the costly purge, and the restoration of discipline, what's left is the original source of its power. That transcontinental railroad for biological data is still running. That high-margin razor and blade model is still generating immense recurring revenue. And the secular tailwinds of genomics are still blowing. The investment question, then, is whether all this recent turbulence has created a margin of safety for a business whose foundational strength has never truly wavered. What remains, through it all, is the enduring power of the Illumina moat,